Why trade hybrid monthly systems when BMR is so good? This is Bill Scheid from Applied Finance Research, and that's the question we're going to answer in this video. It's a question that we've received before, and it's a good one because when we look at the results from our BMR 21 system, they are actually quite good. You'll see here that we have a return that's much better than the S&P 500 on a maximum drawdown that's about the same as 60-40 buy and hold. Compounded annual growth rate 13.1, return to maximum drawdown ratio 20.5, which is much better than S&P or buy and hold. Ending balance of a hypothetical $100,000 account, also much better. Expectancy and SQN by Dr. Van Tharp's subjective standards are both excellent. So why would we do something like mix in one of our PMA systems to create a hybrid, especially when we see that the PMA system has a lower total return, a lower compounded annual growth rate, a lower return to maximum drawdown ratio, or lower ending balance. So what would be the purpose of trading a hybrid system given those numbers? Well, let's take a look at what happens when we create a hybrid out of BMR 21 and PMA SPY, and here we're going to also add our volatility stops and shorts. So we notice, first of all, that the return is greater than either of the subcomponent systems. Now, some of that does have to do with the volatility stops and the shorts, but a lot of it has to do with the fact that the idea behind a hybrid system is that if one of the subcomponent systems is not performing as well, the other subcomponent system can make up the slack. Now you'll notice that while the return is greater than either of the subcomponents, notice how the maximum drawdown is lower than both of the subcomponents. And again, that has to do with the fact that we're diversifying. Basically, we have kind of a system of systems within one meta system. Our compounded annual growth rate is very good, 13.3, again, higher than either of the subcomponents. Our return to drawdown ratio is much higher than either of the subcomponents. We have a higher ending balance, the expectancy is higher, and the SQN score is also higher. So we see a lot of value in creating hybrid systems, mostly because we do get that diversification of systems effects. Now, there is another reason, and I want to take a look at the 2024 results for each of these three systems to point out the reasons. So on the left, we're looking at long-term results, but one of the reasons I like a hybrid system is that in any given year, if one of the systems tends to underperform, like we saw with BMR 21 here, we have a 4.3% return, which isn't bad. I mean, as Dr. Ken Long would say, if you don't want your 4.3%, you can send it to me. And a maximum drawdown of minus 12.4%, which again is also not bad. However, take a look at how PMA SPY did in 2024. We had a total return of 24.9% on a maximum drawdown of minus 8.40%. So if you were trading only BMR 21 and you didn't have that PMA SPY component, your results wouldn't be as good as the hybrid system, which returned 14.3% on a maximum drawdown of only minus 3.18%. So there is actually a lot of value in creating hybrid systems, and a lot of that has to do with the diversification of systems within that meta system. This is Bill Scheid from Applied Finance Research. Thank you very much for watching, and happy investing.